Welcome back to the Commercial Real Estate Show, where we always like to have fun. I'm Michael Bull. Thanks for being with us. Today we're talking about REITs, and we have Calvin Schnure with us and Brad Case joining us from DC on Skype, and glad to have you guys with us. And I got a question for you, gentlemen. What do you say to the folks who are suggesting that commercial real estate is in a bubble situation, that these, what some people are saying are artificially low cost of capital, are creating overvalued assets of all types, and especially commercial real estate, and they point to 3%, 2.5% cap rates in some of these core assets and some of the gateway markets, and suggest maybe these folks are overpaying or these assets are overvalued?
You should keep in mind the things that you see when you have a bubble that bursts. Probably the biggest thing that you see is you've had overbuilding. You have a lot of construction, you have excess capacity coming on the market. And if this happens at a time when demand starts to slow, you see the other thing is where you'll see rising vacancy rates. You'll see slowing rent growth. The combination of overbuilding and some weakening demand and slowing rent growth many times also comes where you have very rapid debt growth. You put those three things together, and that's a real warning sign. But where are we right now? We're actually seeing a fairly moderate level of construction. Sure, there's a lot more construction than there was 2 or 3 years ago, but it's normal to see cranes in a city. I think from 2009, 10, 11, 12, a lot of people got used to walking around the skyline and you don't see those construction projects going, and now they're cropping up. So it's got some people worried. But if you look at the total amount of construction on commercial real estate, it's only about back to where it was 20 years ago in inflation adjusted terms. So it's really not it's not well into a boom phase even yet. And we're seeing continued rising occupancy that's supporting solid rent growth across most of the property types. Office and apartment are doing reasonably well. CBD office is doing very well. The retail sector is still lagging a little bit. But then the final point here is, are we seeing excessive leverage? You mentioned the low cost of debt or low cost of capital. You're seeing more lending. Lending had been really slow for quite a while, but it's only growing at about 6%, 7%. Annually. That's about half of the rate that it was a decade ago. So we're not seeing overproduction. We're not seeing rising vacancy rates. We're not seeing a lot of debt use. That suggests that what we're seeing is property price appreciation that's really affecting solid fundamentals in this sector.
Yeah, I would agree. I'm also quite optimistic about the state of the real estate economy generally. I think that the only thing that gives me some pause is that we have seen a difference in valuation in the public and private sides of the real estate market. And this can happen depending on the way that capital is raised. So what we've seen recently is that some of the big deals, and you mentioned some of the gateway cities, some of the big deals that we've seen in those gateway cities have been buyers from outside of the U.S. Trying to make sure that their money is safe by putting it in very high quality assets in very large economic centers in this country. And that's fine. But it has resulted in a difference in values where values being paid in the private part of the real estate market seem to be higher than values paid for REITs. And REITs have been taking advantage of that, in some cases by selling assets to the private side of the market. And that's what we call public-private arbitrage. It's a real opportunity for REIT managers to create value for shareholders by taking advantage of that difference in valuations. So going forward, I expect that difference in valuations to close, probably through some combination of improvement in REIT stock prices and maybe some softening in the rate of growth of private real estate values.
Yeah, well, that makes a lot of sense. And back to the bubble question itself, I think it's hard to suggest that it's a bubble when, Calvin, like you said, we have rising rents, we have rising occupancy, and we have such a severe lack of new construction. And then when you add the economy, like you said, the economy is improving, so the outlook for the need for commercial real estate looks fantastic, doesn't it?
Yeah, and I stress three things. One of them is see if I can remember which three they are. One of them is you need to have continued strong fundamentals. You need to have continued job growth, real GDP growth, the economy continuing to grow. The other is, at some point, the construction is going to slow down and perhaps level off. Right now, there's no sign of overbuilding on a national basis. Most major markets are really meeting the demand that they have. But if you extrapolate that 2, 3, 4 years, at some point, this question is going to become much more of a current concern. And then the third is the valuation. Right now, I'm a little bit more optimistic than my colleague Brad about what current valuations are. I think they're well supported by the fundamentals. But if you continue to have the very strong price gains that we have year after year, of course, they could lead to some of the cycles we've seen in the past, but we have yet to see if that's the case. It's certainly not the case right now.
What's your quick answer to the amount of demand that we're seeing for commercial real estate property from domestic and foreign and commercial real estate? If interest rates rise and there's other investment opportunities, do you think we'll have this same type of demand?
Oh yeah, I think so. Because number one, as I mentioned, REITs offer a combination of investment attributes that investors really value that they're not getting from others. That is to say, a strong total returns, as we said, slightly better than the rest of the stock market over long periods of time, with relatively low volatility compared to other similar investments in the stock market, and that very, very strong diversification. But on top of that, as Calvin mentioned, we've been seeing strengthening in the economy. We think there's what we call latent demand, which is people who are not yet currently looking for real estate, looking to rent an apartment, not yet currently looking to fill out more office space, but they have it in their minds. And as soon as their financial situation has improved just a little bit, they're going to be back in the market.
I would agree with that. And we're going to take a short break. When we get back, we'll talk about the real estate cycle. Where are we? I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. Stay with us.
The Commercial Real Estate Show is brought to you by Bull Realty, a great place to do business. Xceligent, information for the professionals. And Commercial Search, properties for sale and lease. To access these companies or for additional videos, podcasts, and articles, visit CREshow.com.